I call the committee to order and move to executive session. Today, the committee will vote on the nominations of 3 individuals to serve in key leadership roles within the Department of Housing and Urban Development. Brian Montgomery, the nominee for HUD Assistant Secretary for Housing and Federal Housing Commissioner, would once again provide steadfast leadership to FHA as he did a decade ago. Hunter Kurtz, the nominee for Assistant Secretary for Public and Indian Housing, has spent nearly his entire career in affordable housing, including implementing successful housing programs both federally and locally. And Susan Tufts, the nominee for Assistant Secretary for Administration, is a recognized expert in turnaround management and leadership development for both government and nonprofit organizations. Each of these nominees will bring a wealth of experience and expertise to HUD as they work to promote access to safe and affordable housing for families across America. I urge my colleagues to support them today so that they can quickly begin this important work for our country. Senator Brown.
Thank you, Mr. Chairman. As you said, the committee will vote today on 3 of the President's nominees to serve at HUD. I want to congratulate each of the nominees again and thank them for their willingness to serve our country. If confirmed, the nominees before us would, 1, oversee rental assistance for 4.5 million low-income seniors, individuals with disabilities, and families, would manage the federal government's primary mortgage insurance programs, would ensure that HUD has the workforce necessary to deliver on its important mission. We're considering these nominees at a time when the nation faces a number of housing challenges. These range from the growing shortage of affordable housing, rental housing, to the tight mortgage markets that are shutting so many credit-worthy borrowers out of home ownership. I'll be supporting Ms. Tufts' nomination today. I hope she'll use her experience to advocate for HUD's workforce and empower HUD employees to further their mission. I will not be supporting the nomination of Mr. Montgomery. Mr. Montgomery, having served previously in the position for which he has been nominated, would bring valuable experience and appreciation for the importance of the programs he would lead. If he's confirmed, he's spoken about the value of the FHA as both a responsible engine of home ownership and a counter-cyclical tool to ensure mortgage credit remains available. He also supported the Office of Housing's affordable housing programs. I'm concerned, though, that Mr. Montgomery will, in the interest of making the FHA a better partner to the mortgage industry, many of whom he has served as a board member or advisor, that he will lose sight of the interests of FHA and of consumers. I will support Mr. Kurtz's nomination. He does not have experience with the programs he'd oversee at PIH. However, he has a record of successfully administering other HUD and local programs and a passion for affordable housing. I support this nomination based on the assurances he has given to me and to my staff and members of the committee that he will advocate for the program he administers in future budget deliberations. He's assured us he'll work quickly to implement the Housing Opportunity through Modernization Act Congress passed in 2016, that will work for positive outcomes for residents. He'll engage with residents and their advocacy organizations. Okay. While I support his nomination, so many of us are concerned that his passion is unlikely to be matched with resources from the administration. This administration has proposed large cuts to PIH programs, saying that they can make up for these cuts by relying on flexibility and public-private partnerships. Meanwhile, they propose cuts to the funding streams necessary to support these partnerships. At the same time, the administration now throws its weight behind a $1.5 trillion in tax cuts aimed predominantly at corporations and the wealthy, including provisions that would undermine the very tax incentives that the administration relies upon to fund its public-private partnership, making that promise of relying on public-private partnerships and flexibility look empty. In this scenario, the flexibilities that Mr. Kurtz and the administration advocate could just become ways to pass the buck for budget cuts to local communities and ultimately low-income families. We've seen that time and time again. Programs helping working families and seniors will be cut in the name of a shared sacrifice that is not actually shared. I hope that Mr. Montgomery and Mr. Kurtz prove me wrong. I hope that under their leadership, HUD will emerge as a strong advocate for consumers, for affordable housing, and for assisting families. These matters are far too important to too many Americans not to be. Thank you, Mr. Chairman.
Thank you, Senator Brown. And any additional senator wishing to make a statement, though we are not encouraging it, may do so after the vote. We do want to move on to our guest here, but any senator who does want to make a statement on the votes that we are going to have may do so after the votes. We will proceed with a roll call vote on Mr. Montgomery and then separate voice votes on Mr. Kurtz and Ms. Tufts. And I would like to move forward with the voice votes first. And so at this point, we will proceed to the nomination of Robert Hunter Kurtz to be Assistant Secretary for Public and Indian Housing. All in favor say aye. Aye. All opposed, no? No. The ayes have it. The nomination is hereby ordered reported favorably to the full Senate. On the nomination of Suzanne Israel Tufts to be HUD Assistant Secretary for Administration, all in favor say aye. Aye. All opposed, no. The ayes have it. The nomination is hereby ordered reported favorably to the full Senate. We will now proceed to the roll call vote on the Honorable Brian Montgomery to be HUD Assistant Secretary for Housing and Federal Housing Commissioner. The clerk will call the roll.
Mr. Chairman?
Aye.
Mr. Shelby?
Aye by proxy.
Mr. Corker?
Aye by proxy.
Mr. Toomey?
Aye by proxy.
Mr. Heller?
Aye.
Mr. Scott?
Aye by proxy.
Mr. Sass?
Aye.
Mr. Cotton?
Aye by proxy.
Mr. Rounds?
Aye.
Mr. Perdue? Mr. Tillis?
Aye.
Mr. Kennedy? Mr. Brown?
Aye. No, I'm sorry, no.
Mr. Reed?
No.
Mr. Menendez?
Aye.
Mr. Tester?
Aye.
Mr. Warner?
Aye.
Ms. Warren? No. Ms. Heickamp? Aye. Mr. Donnelly?
Aye.
Mr. Scott? Mr. Van Hollen? Ms. Cortez Masto?
So I lied at 6.
Mr. Chairman, the vote is 18 in favor, 5 opposed. The nomination is approved.
The ayes have it. The nomination is reported favorably to the full Senate. And are there any senators who do wish to make a statement at this time? Senator Warren.
Thank you, Mr. Chairman. I oppose the nomination of Brian Montgomery to serve as the head of the Federal Housing Authority. This is one of the worst cases of the revolving door that I have ever seen. As you know, FHA provides taxpayer-backed mortgage insurance, helping millions of Americans buy homes they might not otherwise be able to afford, and unless it's managed well, the FHA could expose taxpayers to a risk of billions of dollars in losses. Mr. Montgomery ran the FHA before, from 2006 to mid-2009, and during his time in charge of the agency, big banks like Wells Fargo and U.S. Bank submitted thousands of fraudulent mortgages to the government for taxpayer-backed insurance. Mr. Montgomery apparently did nothing about it. But a month after leaving the FHA, Mr. Montgomery founded a new company which was, quote, known in the housing finance industry as a specialist in helping firms navigate FHA-related penalties and lawsuits. And Mr. Montgomery's new company advised Wells Fargo and U.S. Bank on how to pay the government back as little as possible for their fraud. That's right, Mr. Montgomery's company advised banks on how to pay as little as possible for fraud that occurred on his watch at the FHA. And now he's been nominated to run the FHA again. Are you kidding me? FHA needs leaders the American people can trust, not people who let banks get away with defrauding the agency and then making money from those same banks. We can't expect Washington to work for working families if nominees like this are confirmed. I understand that the committee has advanced Mr. Montgomery's nomination today, but I hope that the full Senate will reject this nomination. Thank you, Mr. Chairman.
Thank you, Senator Warren. Any other senators wish to speak? With that, we will close our executive session and move to the hearing. Now, Mr. Powell, would you please take your seat at the table? And the committee will come to order for the hearing. This morning, we will consider the nomination of the Honorable Jerome or J. Powell to be Chairman of the Board of Governors of the Federal Reserve System. Governor Powell, welcome and congratulations on your nomination. I see friends and family behind you, and I welcome them here today as well. Governor Powell has had an accomplished public and private sector career in financial services. He served as an Assistant Secretary and Undersecretary of the Treasury under President George H.W. Bush, where he was responsible for policy on financial institutions and the Treasury debt market, among other areas. He also has firsthand experience in investment banking and was a partner at the Carlyle Group before being appointed to serve on the Board of Governors in 2012. During his years of service in government and in the private sector, Governor Powell has proven he is qualified to lead the Fed. If confirmed, he will play an important role in striking the proper balance between the need for a safe and sound financial system and the need to promote a vibrant, growing economy. Over the past year, I've been encouraged to see the federal regulators carefully and thoroughly evaluating current laws and regulations. Governor Powell has shared specific areas in the past where the Fed believes some laws and regulations can be changed to alleviate burden, including the Volcker Rule, stress tests, and resolution plans, among others. Several weeks ago, 13 members of this committee, including myself, introduced legislation to improve our nation's financial regulatory framework and to promote economic growth. Introduced by 10 Democrats and 10 Republicans, the bill demonstrates very strong bipartisan support for tailoring and simplifying regulations. Part of the bill tailors regulations for smaller financial institutions and community banks, while at the same time improving access to mortgage credit and housing and ensuring strong consumer protections. The legislation also addresses the $50 billion SIFI threshold, for which Governor Powell, Chair Yellen, and many others have expressed support. On the monetary policy front, I was encouraged by the Fed's June announcement detailing the approach it will use to reduce its asset holdings in a gradual and predictable manner. As the Fed continues its path to normalizing monetary policy, which I hope it does continue, clear communication should be a central priority. I look forward to working with the Federal Reserve on some of these issues and welcome any additional thoughts or ideas that Governor Powell has on areas where the Fed and Congress can act to further reduce unnecessary burden and promote economic growth. Congratulations again on your nomination, Mr. Powell, and thank you and your family for your willingness to serve. Senator Brown.
Thank you, Mr. Chairman. Welcome, Governor Powell. Nice to see you. I want to start off by thanking Janet Yellen, the chair of the Federal Reserve. She has done an excellent job leading the Fed. During her tenure as chair and as vice chair, the U.S. experienced one of the longest economic expansions in its history, an expansion we still enjoy. As I said at the time of her nomination, Chair Yellen was among the most qualified people to ever be nominated to be chair of the Federal Reserve. You don't have to have a doctorate in economics to lead the Fed, but we were lucky that both she and Chairman Bernanke were students of the Fed's mistakes in the 1930s. Her strong and steady stewardship of an independent central bank following the worst financial crisis since the Great Depression ensured that we did not repeat those mistakes. Chair Yellen was, as we know, the first woman ever to serve as chair of the Board of Governors of the Federal Reserve. I'm disappointed that President Trump has broken with the tradition of reappointing the last president's Federal Reserve chair. This administration has also broken with the tradition of trying to make the federal government more diverse. That said, those decisions, Governor Powell, were not yours. I congratulate you on your nomination to be chair of the Federal Reserve Board of Governors. We've had a good working relationship since you were first nominated to be a member of the Fed by President Obama in 2012. I hope that will continue. You've supported tough rules for the nation's largest banks as the Fed implemented Wall Street reform. For that, we're appreciative. As chair of the Reserve Bank Affairs Committee, you work to put more diverse individuals in the top spots at the regional Federal Reserve banks, on their boards and throughout the Fed's workforce. Much more needs to be done. There has been some progress. And you understand the importance of an independent central bank. You strongly opposed misguided congressional efforts to micromanage the Fed and make other changes that undermine the ability of the Fed to conduct its monetary policy. I hope you'll stick to those positions on these important matters and on others. But there are good reasons to be concerned. The current administration does not appear to value independence in the judiciary, the FBI, or the Federal Reserve. It's in an unprecedented way. The president has made comments about the current Fed chair as well as interest rates. The search for the Fed chair too often seems like an episode of The Apprentice. I'm concerned about the direction of financial regulation under the current administration. While banks across the board make record profits, once again paying executives big bonuses, the administration makes unfounded claims in order to justify the rollback, the reforms put in place after the crisis. The new vice chair for supervision at the Fed does not seem to be inclined to support the current regulatory framework put in place by the Fed since the crisis. He has troubling views on stress tests and more generally the role of watchdogs in the financial system. Industry has an outsized influence. Industry, especially Wall Street, has an outside influence on this administration. The individuals have put in charge, the individuals that they've put in charge as financial watchdogs are far too often former bankers or former bankers' lawyers, or bankers' lawyers. Some federal bank regulators seem willing to abet rather than combat regulatory arbitrage. The June Treasury report on financial regulation put out by Treasury Secretary Mnuchin was a big bank wish list. In formulating the report, Treasury met with 17 industry representatives for every consumer group representing an ordinary American. 17 industry representatives for every consumer group representing ordinary Americans. Mr. Powell, even your schedule indicates you are meeting far more frequently with industry than with consumer groups. You've met with Wells Fargo CEO more times than all the consumer groups on your schedule combined. This administration has already forgotten the Americans who lost their jobs and their homes and their retirement savings less than a decade ago. I take this personally in many ways. As members of this committee have heard me say, my wife and I live in Cleveland, Ohio, in zip code 44105. That zip code in the first half of 2007 experienced more foreclosures than any zip code in the United States of America. I still see the blight 200 yards from my house that happened in large part because of Wall Street overreach. The loss to so many Americans of jobs, of homes, of retirement savings was particularly harmful to African Americans and Latino communities, which have not recovered from the financial crisis as quickly as white Americans. The financial industry is doing better than ever. There seems to be a collective amnesia in this room, in this committee, in this Congress, a collective amnesia about what happened 10 years ago. But Americans still struggle because of low wages, because of underemployment or unemployment and lack of opportunities. Loosening the rules for some of the country's largest banks is not the way to solve these problems. Your record has been strong on a number of these issues. We urge you to continue that record. I look forward to hearing your views on the direction that you will take monetary policy and bank regulation and central bank decisions. I hope you will make your decisions based on facts, independent from the political pressure from the President of the United States and from the Treasury Secretary. Thank you.
Thank you, Senator Brown. At this point, we will administer the oath. Governor Powell, will you please rise and raise your right hand? Do you swear or affirm that the testimony you are about to give is the truth, the whole truth, and nothing but the truth, so help you God? And do you agree to appear and testify before any duly constituted committee of the Senate? Thank you. You may be seated. Your written statement will be made a part of the record in its entirety, and I invite you to introduce your family in advance of making your statement. Governor Powell, you may proceed.
Thank you, Chairman Crapo and Ranking Member Brown. And I will begin, as you suggest, by introducing my wife, Alyssa, without whose loving support and wise counsel someone else would be sitting here. I'll also introduce two of my 5 siblings here today, my sister Libby and my sister Monica. The other 3 siblings are here in spirit, and all will later claim to have watched this hearing live.
Which I'm sure will be true.
We'll deem it true.
That's right.
Some stories are too good to fact check. So thank you again, Chairman Crapo and Ranking Member Brown and other members of the committee for expeditiously scheduling this hearing and providing me the opportunity to appear before you today. I would also like to express my gratitude to President Trump for the confidence he's shown by nominating me to serve as Chairman of the Board of Governors of the Federal Reserve System. The Federal Reserve has had a productive relationship with this committee over the years, and if you and your colleagues see fit to confirm me, I look forward to working closely with you in the years ahead. As you know, I have served as a member of the Board of Governors and the FOMC for more than 5 years, contributing to our work in a variety of capacities, including most recently as Chairman of the Board's Committee on Supervision and Regulation. My views on a wide range of monetary policy and regulatory issues are on the public record in speeches and testimonies during my service at the Fed. Congress established the Federal Reserve more than a century ago to provide a safer and more flexible monetary and financial system. And almost exactly 40 years ago, you assigned us the dual monetary policy goals of maximum employment, meaning that people who want work either have a job or are likely to find one fairly quickly, and price stability, meaning that inflation is low and stable enough that it need not figure into households and businesses' economic decisions. I've had the great privilege of serving under Chairman Bernanke and Chair Yellen, and like them, I will do everything in my power to achieve those goals while preserving the Federal Reserve's independent and nonpartisan status that is so vital to their pursuit. In our democracy, transparency and accountability must accompany that independence. We are transparent and accountable in many ways. Among them, we affirm our numerical inflation objective annually, and we publish our economic and interest rate projections quarterly. Since 2011, the Chairman has conducted regular news conferences to explain the FOMC's thinking. Additionally, we are accountable to the people's representatives through twice-a-year reports and testimony, as well as through oversight and audited financial statements. I am strongly committed to that framework of transparency and accountability and to continuing to look for ways to enhance it. In addition, in our federated system, members of the Washington-based Board of Governors participate in FOMC meetings with the presidents of the 12 Federal Reserve banks, which are deeply rooted in their local communities. And I am a strong supporter of this institutional structure, which helps ensure a diversity of perspectives on monetary policy and also helps sustain the public's support for the Federal Reserve as an institution. If confirmed, I would strive along with my colleagues to support the economy's continued progress toward full recovery. Our aim is to sustain a strong jobs market with inflation moving gradually up toward our target. We expect interest rates to rise somewhat further and the size of our balance sheet to gradually shrink. However, while we endeavor to make the path of policy as predictable as possible, the future cannot be known with certainty. So we must retain the flexibility to adjust our policies in response to economic developments. Above all, even as we draw on the lessons of the past, we must be prepared to respond decisively and with appropriate force to new and unexpected threats to our nation's financial stability and economic prosperity, the original motivation for the founding of the Federal Reserve. As a regulator and supervisor of banking institutions in collaboration with other federal and state agencies, we must help ensure that our financial system remains both stable and efficient. Our system is without doubt far stronger and more resilient than it was a decade ago, with higher levels of capital and liquid assets, with greater awareness of the risks that banks run, and greater ability on the part of the banks to manage those risks. Even as we have worked to implement improvements, we have also sought to tailor regulation and supervision to the size and risk profile of banks, particularly community institutions. We will continue to consider appropriate ways to ease regulatory burdens while preserving the core reforms of strong levels of capital and liquidity, stress testing and resolution planning, so that banks can provide the credit to families and businesses necessary to sustain a prosperous economy. In doing so, we must be clear and transparent about the principles that are driving our decisions and about the expectations we have for the institutions that we regulate. To conclude, inside the Federal Reserve, we understand that our decisions in all these areas matter for American families and communities. I am committed to making decisions objectively and based on the best available evidence. In doing so, I would be guided solely by our mandate from Congress and by the long-run interests of the American public. Thank you, and I'll be happy to respond to your questions.
Thank you, Governor Powell. The Fed recently began the process of shrinking its balance sheet, which currently sits above $4 trillion. In a speech earlier this year, you cited long-run estimates of the appropriate size of the balance sheet as about $2.4 to $2.9 trillion by 2022. Would you clarify what you do believe is an appropriate stable size for the Fed's balance sheet, and what factors you expect to focus on in determining the pace and the ultimate scope of the balance sheet reduction?
I will, Senator. So the Fed's balance sheet is about $4.5 trillion now, and we know that it will be much smaller than that when it reaches its new sort of equilibrium size. It will be larger, however, than it was before the crisis. And we've also said that it will consist primarily, mostly, of Treasury securities at that time. And it will be no larger than it needs to be for us to conduct monetary policy. We will be shrinking the balance sheet by allowing securities, as they mature, to roll off passively. And that process should take 3 or 4 years before we reach our new sort of stable level of the balance sheet. And the factors that will determine that will be really, in the end, the public's demand for our liabilities, particularly cash and reserves. Those will be principal factors that will decide what the final size of the balance sheet will be. We don't actually know what that demand will be, but my own thinking, it moves us to a balance sheet in the range of, as I mentioned, $2.5 to $3 trillion. Again, there's no certainty in that.
All right, thank you very much. And the last time you appeared before the committee, you stated, it is very important that the intensity of regulation be tailored appropriately for the risks that the institutions present. There's bipartisan support to tailor existing regulations and laws to ensure that they are proportional and appropriate. Are there any specific areas that you think could benefit most from tailoring?
Yes. So first let me say that tailoring of regulation is one of our most fundamental principles. We want regulation to be the most intense, the most stringent for the very largest, most complex institutions, and we want it to decrease in intensity and stringency as we move down through the regional banks into the community banks. So this is something that we strive to achieve. We're taking a fresh look at that right now, and I would just point out a couple of areas. I think in certainly capital. We require of the largest banks higher capital, and we have less stringent requirements as we move down, and more simple capital requirements as well. I would also point out something like the Volcker Rule, where really it can apply in its strongest form to the banks that have very large trading books, and much less stringently, we believe, as we go to the smaller banks. In fact, I saw that your proposed bill exempts banks under $10 billion in assets from the Volcker Rule, which is something that we've been in favor of.
Well, thank you. And actually, my next question is on that bill. As you just pointed out, 2 weeks ago, 20 U.S. senators introduced the Economic Growth, Regulatory Relief, and Consumer Protection Act. And I'm not going to ask you to get into the business of the politics of that act here with us. But I do want to know, do you believe, if you've had a chance to review it, do you believe that that act, if enacted into law, will provide significant regulatory relief to community banks, mid-sized banks, and regional banks, while still giving the Federal Reserve the authority it needs to supervise and regulate those institutions?
I do. On both counts, Senator, I do.
All right, thank you. And lastly, for me, housing reform. After our economic growth markup next week, housing finance reform will be one of my top priorities for the remainder of this Congress. Earlier this year, you gave a speech in which you outlined a few principles for housing finance reform. And in your words, do whatever we can to make the possibility of future housing bailouts as remote as possible. Number 2, change the system to attract large amounts of private capital. Number 3, any guarantee should be explicit and transparent and should apply to securities, not to institutions. And number 4, identify and build upon areas of bipartisan agreement. I strongly agree with these points that you made and believe that there is bipartisan support to seek a solution in that zone. Would you commit to work with the committee on our efforts to pass housing finance reform?
Yes, I will, Senator.
And I guess I'll just take my last 15 seconds to ask you one final question on that. And I believe housing reform is one of the most significant issues we need to make next. That's why I said I would prioritize it. How would you rank housing finance reform in terms of the importance that we move to it and get it resolved?
I think it's a highly important piece of unfinished business from the financial crisis. And I think there have been a lot of great proposals. And I think this, at a time when the economy is healthy, this is a great time to move forward on it. And I look forward to working with you on it.
Thank you. Senator Brown.
Thank you, Mr. Chairman. In 2013, you stated that the Fed was created as an independent agency. A broad consensus has emerged among policymakers and other informed observers around the world that, and most important part of the quote, that better economic performance is achieved when the conduct of monetary policy is free from political control. What will you do, if confirmed, to ensure that the Fed maintains its independence from outside political influence, especially influence from the White House? And be as specific as you can.
Senator, I'm strongly committed to an independent Federal Reserve, and I would add nothing in my conversations with anyone in the administration has given me any concern on that front. And I just would plan, if confirmed, to follow in the footsteps of distinguished prior chairs and of our long tradition, really, to assure that we do conduct monetary policy and financial regulatory policy, by the way, without a view to political outcomes, but with a view solely to the right answers.
Thank you. The Senate this week will vote on a tax bill that will reduce federal revenues substantially over the next 10 years. When the country fell into the Great Recession a decade ago, the Fed had to resort to extraordinary measures, in part because of the tepid fiscal stimulus provided by Congress. 9 years later, amidst one of the longest recoveries on record and low overall unemployment, some of my colleagues think now is the time for $1.5 trillion in attempted stimulus. What does the Fed anticipate will be the impact on GDP growth over the next decade if the tax cuts are enacted along the lines of the bill before the Senate?
Senator, we don't have an estimate of that, and I would say these fiscal policies are important matters for you and your elected colleagues to decide.
With all due respect, Governor, the Fed's projection for long-term GDP growth now is 1.8%. That's the stated federal projection over the next 3 years. I have to assume that with the staff, the highly skilled, not tiny staff that the Fed has, that you have done modeling in all kinds of different ways, different legislation, different ideas coming out of the House and Senate. You have an FOMC meeting coming up in maybe 2 weeks. Are you telling me the Fed has not modeled any of the tax bill and these kinds of tax cuts and what it will do to economic growth?
Senator, of course we're monitoring these discussions, but it remains unclear exactly what will pass, and so it's really, in my view, it's been very difficult or impossible for us to start to incorporate.
But you know, Governor, that the overall arching theme of this is 1.5 trillion in tax cuts. That it will cause greater economic. It'll cause a larger deficit. You know that people on this side of the aisle claim, as they always do, every time there's a tax bill that will grow out of that. Don't you have a responsibility in an ongoing sort of way to talk to us about the modeling that you've done, that what this will mean to the fiscal situation of our country in the years ahead?
I think our responsibility is to carry out the mandate that you've given us, which is to achieve stable prices and maximum employment, and also look after the financial stability.
But of course, we rely on you for data all the time.
But respectfully, Senator, I don't think you rely on us to score fiscal proposals. That's not really our role, and I don't have a forecast for you on that today.
Okay. We've discussed the need for an independent Fed. Do you believe it's important for the other independent financial regulatory agencies to be free from administration pressure? The independent agencies to be free from administration pressure?
I think it's good for all supervisory regulatory agencies to operate doing the best that they can with their mandates and not to not to look at the politics of things.
I can't tell if that's a yes or no.
I wouldn't want to hypothetically sort of agree with your hypothetical that there's political pressure.
Well, I'm not saying, I'm not asking that. I'm asking, should regulators at the various independent agencies be free from administration pressure? Should they be free from independent pressure? I'm not asking you if they are now.
Certainly on individual enforcement and matters like that, I think the administration is well within its rights to express its views on different regulatory matters. But as it relates to supervision of individual institutions, absolutely.
Is independence well served by the appointment of an interim agency head who holds another full-time position that reports directly to the president and the president's chief of staff?
Senator, I have to say that's not something that's in my bailiwick to deal with.
And you have no opinion of that?
Not today, no.
Okay. Tomorrow? I'm concerned, as I think we all are, about the administration's attempt to push out a full-time independent director at the CFPB in favor of a part-time political appointee with a history of attacking the Bureau. And I'm concerned about that attitude infecting other independent agencies. I'm concerned about the tradition or the potential the way that the president could look at this and begin to do this in other places, a non-confirmed appointment like he's doing to the trying to do, the judge will decide, to the CFPB. And I'm concerned too, Mr. Chairman, that one of the first things that Mr. Mulvaney did as quote unquote acting director was to stop payments to consumers, to service members, to veterans, payments where they were wronged, civil penalties, payments that they were wronged by banks and that they need to be made whole, and this director stopped it. And that kind of political interference, I bring that up, one, because a lot of us in this country are very unhappy with what happened, but second, I bring it up as a warning to all of us that independent agencies meet independent agencies. I've watched your career. You've followed things with integrity. You've done things with integrity, but I do worry about White House pressure and a White House we've never seen the likes of in terms of not understanding the independent judiciary and the independence of the FBI and the independence of CFPB and the independence of the job you will have at the Federal Reserve. Thank you.
Thank you. And I did give the ranking member a little latitude on the clock there.
Mr. Chairman.
I'm going to encourage the rest of my colleagues to please recognize the clock. Senator Rounds.
Thank you, Mr. Chairman. Mr. Powell, first of all, congratulations on your nomination. I think the first time that you and I met was when you were a visiting scholar at the Bipartisan Policy Center here in Washington, and I most certainly appreciated your thoughts and common sense approach to not only federal policy with regards to the budget, but I was very, very happy to see when you had been appointed as a member of the Federal Reserve as one of the governors. And I think the fact that you have worked with Chairman Yellen and that you have worked through issues with her, I think that speaks in terms of how you would handle a board and in terms of how you would approach policy. I'm just curious. I was listening to your comments with regard to that which Senator Crapo was visiting with you on, and one of the most common criticisms that I've heard about our government's current regulatory structure is that financial regulations aren't written according to the risks that they're meant to mitigate. Treasury Secretary Mnuchin talked at length about this during his confirmation hearing, saying that bank regulations should be tailored to activity, not just to the size of the institution. Many of the recommendations in the Treasury report on depository institutions that was released in June also discussed this issue with respect to a number of regulations. Earlier this year, I was able to once again reintroduce the Taylor Act, which would require federal regulators to more precisely tailor the regulations they issue based on the risk profile of the institutions that they're writing regulations for. In response to Chairman Crapo, you agreed that tailoring regulations is important. Can you elaborate on this view as it applies to asset thresholds? And should we have asset thresholds to begin with?
So the decision over whether to have a numerical threshold or not is clearly one for Congress, and Congress has tended to, it provides clarity, of course. A numerical threshold makes it very clear who is and who isn't covered above a certain level. And that's nice. If you go entirely with a discretionary approach, then you're leaving the regulators a lot of room to decide things. And so Congress has generally come down and done both. And I think maybe both are appropriate. I do think, though, that fundamentally size is only one indicator. And I think it's healthy, one indicator of the riskiness of a firm and of the possibility of it, damaging the financial system through its failure or through its activities. So the business model really matters, and all sorts of things matter. So I think we have a set of factors that we look at, and I think it's healthy to to look at those too. And we've said that we're willing to work with you on numerical thresholds, on discretionary application of enhanced prudential standards, for example, and we'll work with you on any of those combinations.
I'm sure that you're aware, as the chairman has indicated, that a number of my colleagues on both sides of the aisle and on and off of the Banking Committee have recently come to an agreement on a regulatory relief package that would right-size regulations for smaller financial institutions and improve our financial regulatory framework. I'm pleased to see that we were able to reach agreement on a number of priorities that I had, such as the HMDA data reporting relief, the right sizing of the enhanced supplemental leverage ratio, reform to the way that municipal debt is treated in bank capital requirements, and relief from some of the most arduous supervisory standards in Dodd-Frank. From what you know about the agreement, and I understand that you've had a chance to cursory look through it, Governor Powell, are there any additional reforms that you would recommend the committee include in this agreement or in future legislation? Did we miss some things that were obvious? And once again, this was a bipartisan plan, and that's exactly what we want it to be, and it's a first step for us. But are there some things in there that we should be addressing that we haven't really looked at?
Senator, we did get the text of the bill, I guess, just before the Thanksgiving break, and we've all looked at it quickly. We've agreed to come back to the committee with our technical thoughts and policy thoughts as well. I will just say, and in response to your question, we will be happy to do that. I think generally we look at the framework as a workable one, as a sensible one, and so we'll try to come back with very constructive thoughts on how to bring it forward.
Very good. I look forward to supporting your nomination, sir.
Thank you, Senator.
Thank you. Thank you, Mr. Chairman.
Thank you, Senator Rounds. Senator Reed.
Thank you very much, Mr. Chairman. Thank you, Governor Powell, for your service. As you mentioned in your introductory statement, you have a dual mandate. One is maximum employment, but right now we seem to be doing fairly well. Your comments on where we are with respect to maximum employment?
Maximum employment is indeed our statutory goal, and I guess the thing I would say at the beginning is it's kind of an imprecise thing. You can't look at one particular measure of what that is. So we look at a range of things, and I think, for example, 4.1% unemployment is at or around or even below many estimates of the natural rate of unemployment. So that's one data point. There are other dimensions, though. For example, labor force participation really matters, in particular labor force participation by prime age workers, particularly prime age males. And that is the one measure I think that stands out now as suggesting that there may be more slack, more people that can come back to work. A wide range of other indicators suggest that we're at or near or in the neighborhood of full employment. We really can't be more precise than that. The other one, though, is wages, of course. So we look at wages, and wages, in one sense, are at appropriate levels given low productivity and low inflation. But at the same time, we don't see wages signaling any tightness in the labor market. There's no sense of an overheating economy or a particularly tight labor market. So that's what I would say about maximum employment.
I think those are insightful comments, but it raises a dilemma for both of us, both monetary policy and fiscal policy. That is, as you point out, we have this large number of people who seem to be out of the labor force, but years ago would be in the labor force. We have a group of part-time workers who'd like to be full-time workers, and then wages seem to be not rising at all. And what can we do? I don't think we can claim victory on, as you suggest, on unemployment, but we have to take steps, both monetary and fiscal steps. Any suggestions?
Senator, I would say that really the steps that can be taken are steps for Congress and not so much for us. We can manage demand through a business cycle, and we can try to achieve our goal of maximum employment. But these are very long-running trends. For example, among prime-age males, participation in the labor force by prime-age males has been declining for 60 years, kind of thing. So, and the opioid crisis plays a role in it now. It's making it worse. So these are issues that we don't really have the tools to deal with.
You don't have to respond to this, but I think we've identified some significant problems that affect every household in this country, and the tax bill that's before the Senate doesn't respond, in my view, to any of those problems of how to raise wages directly, how to get people back in the workforce. Oh, by the way, how to prepare for a future in which artificial intelligence, autonomous vehicles are going to be more and more competing with human beings for work. So we got a lot of work to do. Let me ask another question. Could you explain why you think the Orderly Liquidation Authority is so crucial and why it must be retained?
Sure. So my view is that bankruptcy should be the preferred option for the failure of institutions, including very large financial institutions. And I think we've made tremendous progress on that through multiple submissions of living wills and such, much more progress than, frankly, I anticipated we could. However, there may come a time when bankruptcy is not going to work in a very stressful situation that really threatens the economic health of the country, just like happened in 2007, 8, and 9. And in that case, we really will need a backup in the form of something like Orderly Liquidation Authority. It isn't a perfect law or a perfect structure, but we need something like that as a backup, which we can guarantee will be there for a really emergency situation where bankruptcy isn't going to work.
Thank you. Let me make two quick points because my time is expiring. First of all, we talked about this. I spent a lot of time, in fact, I was aided by one of your key staff members who worked for Senator Gregg at the time, in trying to develop the clearing platforms for derivatives. And as you wisely pointed out, we've taken bilateral risk and we've made it mutual risk, but we still have the problem with those platforms. So I would hope that in your tenure, you would look very carefully at this potential for systemic risk, as you indicated before. It's critical. Final point, which I think, unfortunately, probably defines too much of what we do around here today, cybersecurity is an issue that is not going away. It's going to be even more dramatic in your tenure. Chairman Clayton of the SECs had pointed out in his testimony this is something we've got to get on. I sincerely believe we're way behind, and the Federal Reserve has to take a very proactive position with respect to cybersecurity. If you can, in a very few seconds, comment upon your view of cybersecurity.
Well, I agree with everything you said. It's just, it's a very, very important, maybe the single most important risk that our financial institutions, our economy, our government institutions face. We're very focused on providing the resources to deal with it and to make sure that the financial institutions we regulate and supervise address it. There can never be any sense of mission accomplished there. It's just one of those things we're always going to be feeling like we're doing as much as we can, but it's just not enough. But we're very committed, both as it relates to the Federal Reserve as an institution and as to the institutions we supervise.
Thank you. Thank you.
Thank you, Senator Reid. Senator Kennedy.
Thank you, Mr. Chairman. Good morning, Governor. Welcome.
Morning.
I've read those media accounts, too, that in the past year you've met with 50 Wall Street executives. How many community bankers did you meet with in that time?
I don't have a number for you, Senator, but it would certainly be in the hundreds if you consider the state delegations and the other meetings that we've had.
What did the community banks do wrong to contribute to the meltdown in 2008?
Fair to say that the community banks did not contribute to the meltdown in 2008.
Okay. Then why, as a governor, have you repeatedly voted to punish them and regulate them half to death?
I guess I would quibble with that characterization of my votes and of the things that we've done. I like to think that I've been, and frankly my colleagues as well on the board have been very focused on avoiding excessive regulation for community banks. I actually chaired the subcommittee of the the board that its sole job was to make sure that the regulations that we put in place for the larger institutions do not apply to the smaller banks. I understand that this is never a battle that you win. You just have to fight it every day. We do fight it, and we're committed to doing better.
I mean no disrespect, Governor, in saying this, but you need to fight harder. I think you've been in 44 Fed meetings. You've not dissented one time. And the community banks in America have had to pay the price with the overregulation. And I don't understand, given your public statements, that you want to help our community banks. I believe you. I think you're sincere. But you've supported regulating them half to death over the past 5 years.
Senator, I think we're well set up to make progress on that, and I hope you'll hold us accountable for that.
Do we still have banks that are too big to fail?
I think we've made a great deal of progress on that. As I mentioned earlier, I think if you think about where we were before the financial crisis, where really no one had thought, oh, what would happen if there's a run on one of these big money center banks? And really the regulators had no practical choice but to keep them from failing, because they would have brought down the whole financial system with them. So you start from that place, less than 10 years ago, and you look at where we are now. So we now have living wills.
Yes.
We have the banks that
Please forgive me for interrupting, but we're limited strictly to 5 minutes, and I understand what we've done, but I want to ask you again, do we still have banks that are too big to fail in America?
Yeah, I would say no to that.
Okay. I want to ask you about, in 1991, Governor, you were working for the Treasury Department. And by the way, while we're on that subject, what role will Secretary Mnuchin have in helping you make decisions if you're confirmed?
He would have no role in that.
None?
I don't believe so, no.
Zero?
Can't think of any.
Nada? All right, in 1991, while working at Treasury, you dealt with the collapse of the Bank of New England. You prevented a bank run. You decided to guarantee all deposits. How many of the bankers went to jail?
There was some jail going. I can't put a number on it for you.
Okay. In that same year, while you were at Treasury, there was an auction rate bond bid rigging scandal. You remember that? You know
Very well.
Yeah,
I do indeed.
You do. I do too. Maybe some other time we can talk about what an auction rate bond is, but you were in charge of dealing with the scandal by Solomon Brothers. And you did iron out an agreement that penalized the bank. But what about the people who did it? Did anybody go to jail?
Indeed they did. Indeed they did.
Okay, well, that's good to hear. How many?
Again, I'm not sure. I know maybe just one, but it might have been more than one. For sure, though, one in particular did jail time over that.
Isn't it true that throughout this entire auction rate bid rigging process, which cost taxpayers in this country billions of dollars and states, that less than 5 people who participated in these this bid rigging went to jail?
I'm not sure what scandal you're referring to now. I mean, the Solomon scandal was something quite different than that. I'm not actually sure which.
You know what an auction?
I do. You mean this is from this was okay? The auction. Okay. I honestly I wasn't.
I'm over. I want to try to stick to my time. Forgive me for being so direct, but this is obviously an important job, Governor.
Thank you, Senator.
Thank you, Mr. Chairman.
Thank you, Senator Kennedy. Senator Menendez.
Thank you, Mr. Chairman. Governor, congratulations on your nomination. In a speech that you gave in June, you noted that the average hourly wages are rising only about 2.5% per year, slower than before the crisis. And while the nation has experienced the longest post-war economic expansion on record, and corporations have raked in record profits, many families in New Jersey and throughout the country are still waiting for a raise. Some claim that if we give corporations a massive tax cut, families will see their wages rise by an astounding $9,000. Now, I haven't seen any evidence that that's credible. In fact, a 2016 Federal Reserve Board study found there is no evidence that corporate tax cuts boost economic growth unless they are implemented in mid-recession. So in reality, what this comes down to is hardworking families already squeezed with rising housing, medical, and education costs, whose paychecks will now have to foot the bill for a bad deal. So my question is, assuming that there is a plan in which families making less than $75,000 a year would collectively lose more than $59 billion in household income, an income loss that would be as high as $1,350 per year for certain households, explain to us the potential negative economic impacts of such an outcome for middle-class families.
Well, Senator, I guess I would start by saying that part of the deal when you're an economist at the Federal Reserve Board is that you have time to do your own research. And I think the paper you're referring to, if it's the one I'm thinking of, was the research of 3 or 4 individuals. And it doesn't represent a position of the board. It's just someone's research. And so I don't associate that with a position of the board. More broadly, as I discussed earlier, we don't have a model of the effect of these tax bills. That's just not something that we do. We will incorporate, when it's done, fiscal changes that are made. They'll be one of many factors.
Well, let me refine my question. So what I'm asking, it's not a trick question. So what I'm asking very simply is, do you think it's good or bad for the economy if middle-class families were to lose $59 billion in household income year after year?
Well, that I think is an easy one, and yes, I think it would be bad.
All right. Now, what also do you view are the economic risks, both at a household and macro level, if we would add an additional $1.5 trillion in debt?
Again, without commenting on any particular bill, like all of us, I'm concerned about the sustainability of our fiscal path in the long run, and it's something that needs to be attended to over time. I'm very concerned about that.
But it would be a negative consequence to further add to the debt which already exists.
I think we need to be concerned with fiscal sustainability over the long term.
Now, in a speech you gave in June, you said with regards to monetary policy, and I quote, "The problems that some commentators predicted have not come to pass. Accommodative policy did not generate high inflation or expensive credit growth. Rather, it helped restore full employment and return inflation closer to the 2% goal." That's not a study, that's your comments.
That's right.
So can you explain how, in your view, the Fed's monetary policy stance over the last 5 years helped contribute to economic expansion, and how will this inform your approach to monetary policy decisions going forward?
Yes, thank you, Senator. So, I think the Fed remained committed after the financial crisis to provide significant accommodation to the economy as it recovered. When I joined in 2012, which is about 5 years ago, I think unemployment was still above 8%. And I think we've been patient in removing accommodation, and I think that patience has served us well. I think now the economy is strong, unemployment is low, growth is strong. In fact, it appears to have even picked up, and so it's time for us to be normalizing interest rates and the size of the balance sheet as well. So I do think that policy that we've had in place has generally served us well.
Okay.
Serve the country well, rather.
Let me ask you this finally. As you know, health care accounts for nearly 20% of U.S. GDP, including not only the delivery of life-saving, life-enhancing health services, but also fueling innovations in patient care, diagnostic, preventative health, research and development of cures to diseases. Earlier this year, I asked Chair Yellen about the impacts, both at a household and macro level, of a spike in the number of uninsured Americans. And she said that large-scale loss of access to health insurance could have a significant impact on household spending for goods and services, as well as impact job mobility. Do you agree with her assessment?
I think she was referring to some research, and if Chair Yellen was referring to research, we can be pretty confident that she was accurately reflecting what that research said. That sounds right to me.
Okay. Thank you very much.
Thank you. Senator Heller.
Mr. Chairman, thank you, and Governor, thank you for being here. Appreciate you taking time, and glad to have your family here also. Welcome them also. You're about to become the most important economic policy maker in the world. How do you feel about that?
I feel fine about it, Senator.
I'm glad to hear that. Historically, I did not support your nomination in 2012 nor in 2014. Worried about the Wall Street bailouts, concerns about new bailouts and new regulations. But what I'm trying to do is, and as we talked personally, is to try to figure out how to get yes on your nomination this time, and I'll continue to look for that. But I do have some questions for you. You talked a lot in your opening statement about clarity and transparency with the feds. The question I have is, do you continue to oppose audit the Fed legislation?
I do, and I'll tell you why. So the Fed, of course, is audited, and I was, in fact, I chaired the committees of the board that oversee the audit of the reserve banks and the audit of the Board of Governors. So we are audited in the sense in which, you know, the general public would understand that word. It means something very different in the current context, and in this context, what it means is Congress has chosen to shield monetary policy from a policy audit by the General Accounting Office, General Accountability Office, we call it now. And that is, I think, a wise choice that's been made as a way of showing respect for the independence of monetary policy. I think a GAO audit at the request of any member of Congress would be a way for Congress to insert itself into the making of monetary policy on a meeting-by-meeting basis. This is not something I think would serve us well.
Do you still largely support the Dodd-Frank reforms?
That's a big, broad bill. That's 1,000 pages of bill there. So I guess I would say that, you know, if you look at let me broaden it out, if I may, Senator, to the post-crisis reform program, which is broader than just Dodd-Frank. It talks about Basel as well. So I think the things that we've done, higher capital, higher liquidity, stress testing, resolution, I think those are important pillars of reform. We can make them more transparent, more efficient, and that sort of thing. I think other things we can do more tailoring, and that's really what we're involved in right now. But generally speaking, as I said, I think the financial system is quite strong.
You said on October 5th that more regulations is not the best answer to every problem. Do you continue to believe that? And if that's the case, would you work with us to consider changes in Dodd-Frank?
I do strongly believe that, and we'll work with you as appropriate.
Going back to what the ranking member was talking about on GDP, what do you anticipate the GDP being next year?
Next year.
You got to make a decision in December whether or not to raise rates, don't you?
Yeah,
I'm assuming that you have some forecast of GDP over the next 1 to 3 years.
I do. So I would say, let me say this year, I expect GDP to come in around 2.5%, in that range, plus or minus. As you look forward, I would expect something pretty close to that. And the reason is we continue to see, you know, high confidence among businesses and households, accommodative financial conditions, the stock market is strong. It feels like we're going to see continued strength next year.
I want to continue to push on this tax bill that we have here. I'm assuming you're going to tell me the board doesn't have a position on the tax bill.
Yes, Senator, I am.
How about personally? Do you have a personal position on the tax bill?
No, Senator, I don't.
Okay. So let me ask you this question. Are you going to raise rates in December and next year?
You know, I've made it a practice to not to talk really specifically about individual meetings because, you know, that's why we have the meeting. We're all supposed to hold back on that final decision and then go in and listen carefully to each other's views, all the Reserve Bank presidents, all the governors. That's how we do it out of respect for each other. I will say, though, Senator, I think that the case for, you know, for raising interest rates at our next meeting is coming together.
You anticipate that we will be raising rates in December?
Well, to repeat myself, Senator, I'm not going to give you a really specific answer on December because
I don't know what coming together means. That's why I asked the question again.
It means I think the conditions are supportive of doing that, but we need to go ahead and have the meeting and listen to each other. We generally have a rule, you know, it's a communications rule that we're not supposed to be saying exactly what we're going to do before we go in and listen to one another's views.
Okay. All right. I respect that. Governor, thank you for being here, and thanks for taking time.
Thanks,
Mr.
Senator.
Chairman.
Thank you, Senator Warren.
Thank you, Mr. Chairman, and Governor Powell, welcome, and congratulations on your nomination. So before the 2008 crisis, the Fed had a lot of authority to regulate and supervise the biggest banks in the country, but they failed to use that authority. When times were good, it looked like maybe we didn't need strong rules to protect the financial system. And then when things went south, the Fed's failure to put strong rules in place ended up costing millions of people their jobs, millions of people their homes, and millions of people their savings. Under Chair Yellen's leadership for the last 4 years, the Fed has adopted a number of rules to reduce the risk of another financial crisis, and you have supported those rules and helped implement them. I understand that now, if you are confirmed, you intend to take another look at those rules. In your written testimony, you say that you will, and I'll quote you, continue to consider appropriate ways to ease regulatory burdens. So let me ask this. You specifically say that you'll look for ways to roll the rules back. Are there any rules you believe should be made stronger?
Well, I do, yes. I would say if you think of the four principal pillars of reform, I think they can all be made stronger and all be made more transparent, clearer, more efficient. I've also said there are a number of things that I wouldn't roll back.
So what are the rules that you said you would make stronger?
Well, I think if you think about resolution, we will expect firms to continue to make progress on resolvability, on stress testing.
So you would want to see rules that are more aggressive on the living wills, for example?
Yeah, and I'm not so much thinking of more aggressive rules as our expectation.
Well, but that's the question I'm asking about. If you're going to revisit the rules for rollback purposes, which is what you said in your testimony, the question I'm asking is the reverse. I don't want to see a one-way street here where it's all about rolling back rules and it's not considering the places where the rules need to be stronger.
Okay, I get your question. So I would say that there are a lot of problems that we need to address in the banking system. I do think we've had 8 years now of writing new rules, and honestly, I can't really think of a place where we are lacking an important rule. I think we've filled out the rules that we need, and it's really a question now of dealing with things from a supervisory standpoint.
So of all the rules the Fed has issued during your time there, you've been there for 5 years, on capital, on leverage, on liquidity, on stress tests, you don't think a single one should be made tougher?
Honestly, Senator, I think they're tough enough.
Well, okay. I got to say, this worries me. But let me take a look for just a minute here then at the rules you say you want to roll back. A few years ago, the Fed and other agencies finalized the Volcker Rule with your support on that. It prohibits banks from trading on their own account unless it is directly related to customer service. And this addresses one of the main ways that banks got into trouble during the buildup of the financial crisis that sent them to Congress for a $700 billion bailout. Do you support significant changes in the Volcker Rule that apply to big banks, for example, by exempting additional forms of trading?
I do support a rewrite of the Volcker Rule. I do believe we can do that in a way that's faithful to both the language and the intent of the Volcker Law.
So you would favor exempting more trading, for example?
I would favor tailoring the application of the proprietary
Okay, I think
trading.
I would call that weakening the rule. But I tell you what, my time is nearly up, but and I'm going to follow up with questions for the record here. But I am deeply concerned that you believe that the biggest regulatory problem in the country right now is that the rules are too hard on Wall Street banks. That kind of mindset led the Fed to ignore the financial system risks before 2008. It helped lead to the financial crisis, and it helped lead to the recession that followed it. So I'm worried that we not go down this path again, because if we do, it's going to be the same thing. And that is that millions of families are going to pay the price while the banks end up, once again, getting bailed out and with record profits. So I'll submit additional questions for the record, Mr. Chairman, on this line. Thank you.
Thank you, and I note you have 15 seconds credit, but it only lasts for this hearing.
But we did get a second, right?
Maybe. Senator Scott.
Thank you.
Thank you, Mr. Chairman. Governor, good to see you again. Thank you for your availability in the recent past. We have talked about these issues before, and very much like Mr. Kennedy, I've had some concerns relates to past performances. But I do want to talk about specifically the interest rate environment that we have currently. Senator Heller asked a couple specific questions as it relates to increasing the interest rate in the next meeting. As opposed to asking that specific question, I want to paint a story, paint a picture, then ask a question about the interest rate environment overall. If you're a retiree in South Carolina, by the way, a great place to retire whenever that time comes, it certainly has high quality of life, good economy, wonderful places to live. But if you're on a fixed income in Saluda, South Carolina, and you're retired, the current interest rate environment cuts really into your ability to live off of your interest income. As an example, someone with a $10,000 CD, 12-month CD today, earns about 0.25% interest. If you extend that for 5 years, it's still less than 1%. Said differently, if your nest egg is $500,000 or $1 million and you're earning 1 or 2%, you're living off of $220,000 a year. So the significant impact of the artificially, in my estimation, low interest rate environment has a negative unintended consequence, I assume, in the current marketplace. I do realize that the advantage of a low interest rate environment helps spur economic activity. Folks are more likely to buy homes, but that knife cuts both ways. I'd love for you to talk to me about the principles or the characteristics of an economy that would require or encourage a more normalization of our interest rate environment.
Thanks, Senator. So I think we have that economy right now, and that is we have low unemployment, 4.1% unemployment. We've got strong growth. The very low settings of interest rates that were appropriate during the crisis and after to support economic activity are no longer appropriate. And that's why we're raising interest rates now on a gradual path, and I expect that will continue. But I agree, as we discussed, I guess yesterday or the day before, the interest rates are a blunt instrument that we have. And so while low interest rates support economic activity, they lower people's interest bills, they support investment by businesses, it generally has supported a pretty strong recovery, particularly in the labor market. If you really are dependent on fixed income and bank deposits and short-term interest rates, then it's been a burden for you. And unfortunately, but I think overwhelmingly people are helped by lower interest rates and have been. I would just say help is on the way. I do expect that rates will continue to go up, and that will feed through into the interest rates that your constituent is having.
Thank you. As it relates to the balance sheet of the Fed, over the last decade, we've seen that balance sheet balloon. And I know we talked a lot about creating a new starting place for a conversation about unwinding that balance sheet and then getting to a number that would be perhaps our new normal, and not necessarily the $1 trillion that I believe it was beforehand. Right. But can you walk me through what you see as a snapshot in about 30 seconds or less, since my time's running out, of what you see happening with that balance sheet?
Sure. So as we've announced, we are allowing, as bonds mature, we're allowing them to we're just giving the money back to Treasury. And so our balance sheet is shrinking passively and gradually. The market hasn't reacted to that. And on that path, in about 3 or 4 years, we'll be down to a new normal. Now, what will that new normal be? It'll be much smaller than the balance sheet of today. It'll be much bigger than the balance sheet of 10 years ago. And ultimately, that level will depend on two things. It'll depend on the public's demand for cash, which to us is a liability, to them an asset, and also on banks' demand for reserves, which is going to be much higher than it was before the crisis. Demand for cash has more than doubled in 10 years. So those two things are the reasons why the balance sheet will be bigger. And I said earlier, my guess is, and it's a guess, is that it will be somewhere in the $2.5 to $3 trillion range. But the truth is, we don't really know.
Well, with my last 15 seconds, there are 2 points. One, I'm encouraged by your thoughtfulness about taking a look at the asset thresholds that may be a part of Senator Crapo's legislative package, and looking for ways for us to perhaps increase the thresholds that have stringent, prudent regulations. The second thing I'd say is I would encourage, as we look at the SIFI designation in the non-bank arena, having spent a quarter of a century in the insurance industry, I would suggest that clarity on what gets you designated and clarity on how you lose that designation would be incredibly important.
Thank you, Senator.
Thank you. Senator Schatz.
Thank you, Mr. Chairman. Thank you, Governor, for your willingness to continue to serve. Thank you for the conversation we had last week. I want to give you some data points. According to the FDIC, banks had record-breaking profits in 2016 and the highest return on equity in years. Data from 2017 shows that banks are likely to do even better this year across the board. Banks have increased their dividends to shareholders by 17%. Community banks' earnings have also been increasing. They were up almost 10% this quarter compared to last year. Household credit, such as home loans, car loans, credit cards, has surpassed pre-recession highs. And according to the Fed, sluggish loan growth in the commercial sector is due to a lack of demand. And so the question follows on Senator Warren's question, which is, what problem are we solving with deregulation?
I'm not going to characterize what we're doing as deregulation. I would rather think of it as looking back over 8 years of what is very innovative regulation in many cases, things that have never been done, like liquidity requirements and resolution and stress testing. All of those are brand new, and looking back, as I think it's our obligation to do, and making sure that what we did makes sense.
Right, but isn't the objective to get all these metrics up, and aren't these metrics already up? And so doesn't it make sense to err on the side of caution? I understand in principle, some people in principle believe that too much regulation is a problem and it ought to be eliminated almost as an ideological precept. But if you're looking at, as a practical matter, aren't these the data points you want? Aren't we where we want to be in terms of bank profitability? In fact, isn't bank profitability not the problem, but to the extent that there was net income among the 10 bank holding companies in the United States, 99% of their net income was distributed in the form of dividends and stock buybacks. So I ask the question again, what are we fixing and for whom?
Well, let me agree that the banking system is healthy. It's great to see. That was not the case a few years ago, and it's nice to see banks profitably serving their customers again. So we're not looking to change that. And I would also agree that we do want to err on the side of caution, and we think we're doing that. But, you know, even consistent with that, it doesn't help anyone for banks to waste money, if you will, to spend more money than they reasonably need to spend to accomplish these safety and soundness objectives. Those costs will fall on customers and borrowers and such. So it's our obligation, among other obligations, to make sure that regulation is efficient.
You're just saying it's too much paperwork, too much compliance?
Yes, you hear that a lot from, you know, from on different issues. It's different things on different issues, but there's certainly just a lot of regulatory burden, and a certain amount of it is unavoidable. But our job is to be efficient and effective as well as protecting safety and soundness.
Yeah, I guess my concern is that if you're a bank that you both sort of dispositionally and from the standpoint of wanting to make profits, you want to reduce paperwork burden. And no doubt when you lay down a whole new matrix of regulation, there are going to be instances in which it's a pain for a bank, small or large, to comply. But again, they've managed record profitability even despite whatever paperwork and compliance burdens there may be, and there is zero evidence that if we reduce the paperwork burden or the compliance burden, that they will pass on those savings in the form of increased lending or increased remuneration in whatever form to their customers. I only have 50 seconds left, and I just want to follow up on a question that I asked you in private. When the Fed formulates monetary policy, it takes a broad look at the economy and it identifies short and medium-run risks and trends. I have a copy of the minutes from the most recent meeting, and there's a brief discussion of the economic impact of hurricane-related disruptions as well as dislocation from wildfires. The minutes indicate that in the past, these have only had a temporary impact. So I'll take these, I'll offer the questions and then take the answer for the record. How many events would it take to have a material impact on the economy? Has the Federal Reserve considered what number that would be in terms of the number of events or the total cost of the damage? And have you worked with NOAA or other science agencies about the likelihood of the number of severe weather events increasing? My basic point is that I understand this is difficult to quantify, but you are in the business of analyzing things that are difficult to quantify, and I think we now believe that this is material, and I'd like you to consider it, and I'll take those for the record.
Senator Tillis.
Thank you, Mr. Chair. Mr. Powell, thank you for being here. Also, thank you for being so generous with your time and the meetings that you've had in my office. I covered some of this in the meeting that we had in my office, but I want to go back to it again. You've been nominated to a position where you're ultimately going to be, I believe, when you're confirmed, Randy Quarles' boss. You also said in our meeting in the office that you're going to rely a lot on him to take a look at regulatory reform issues, regulatory right-sizing. But in that first meeting that any boss has with somebody that they're working with, they try to give them some direction. So thematically, what are you going to talk about when it comes to recalibration of regs post-crisis? Kind of curious your comments on Basel Committee and the so-called Basel IV. And actually, just if we could start with that and a general discussion about how regulations, it's not about repealing regulations. Some of them need to exist, and if they'd been in place in 2008, we probably wouldn't have had a crisis the magnitude that we had. But now it's almost as if we've either have too many people regulating the same regulations, too many organizations, or we're not really clean in our executions, which is making it very costly, very difficult for businesses and distracting from what they want to do, which is run their business. So that's a compound question. You can answer any part of it or all of it.
Okay, so I'll start by saying my relationship with Randy Quarles goes back so far, I can't think of what a first meeting would be like. You know, I actually hired him at Treasury 25 years ago, and he's been a close friend all the time. I think we're very well aligned on our approach to the issues that he'll face as Vice Chair for Supervision. You asked about Basel. My understanding, and Vice Chairman Quarles has the lead on this now, but my understanding is that there's significant progress toward an agreement among all of the principal participants at Basel around, uniform floors for particular risk categories, and that would give us a way to wrap up Basel III, and I think that would be very much in our interest to do so. It's other countries that have lower floors and lower risk weightings on their assets, so this really helps us.
You know, I just came from a press conference promoting the tax plan that we hope creates economic activity. But in my own personal experience in North Carolina, the two things that really combined created great economic activity were tax reform and regulatory reform. So I'm hopeful over the course of this year, within your lanes, you're doing everything you can to question how regulations get executed, right-sizing them to the point, to the minimum lightest touch necessary so that we are reducing what is an increasing cost in regulatory compliance. And by definition, with all due respect to my friends and colleagues at Price Waterhouse, many of those compliance jobs are by definition non-productive jobs. All they do is count whether or not all the productive activities were cross-tied right. So hopefully we can see some leadership on your part with respect to the Fed and the other regulatory agencies about more clarity, and I think a more tip of the spear. We had the discussion about tip of the spear, regulators staying within their lanes and relying on other ones to the extent they need the information to complete their responsibilities. Now, I have a question about the goal of the Fed over the last 9 years. It's been to increase inflation and not growth. But what has a more corrosive impact on the middle class, low inflation or low growth?
Well, low growth.
And so outside of the things that you're directly responsible for on the supply side, what sorts of things should we be looking at to help stimulate growth?
Let me just amplify our mandate is inflation and maximum employment, stable prices and maximum employment. It's not growth, but so really the things that can increase the sustainable growth rate of the U.S. economy are things that are really in your lane, not so much ours. And I would boil that down into a couple of things. One is labor force participation, and the other is productivity. If you think about it, really you want as many people as possible taking part in the labor force, not just for the overall U.S. economy's good, but for their own good. People are happier and healthier if they're in the labor force. So and there are policies that can affect labor force participation. Productivity is very, very difficult to forecast, and it comes down to technological advance and its effect on economic growth, very, very hard to forecast. It's also, though, the skills and aptitudes that our labor force brings to the job, and that is something that you can affect. It's policies that promote investment in infrastructure, private investment by companies, and I think all of those policies are really in the hands of Congress, and I think it's important that we have a long-run focus on increasing our sustainable growth rate.
So it's outside of your lane, but just a quick question. If you reduce the tax and regulatory burden on certain businesses, in your opinion, will there be more or less investment in productivity?
I mean, I think there clearly are ways in the tax code to support different kinds of activity, and certainly investment is one of those.
Thank you.
Thank you. Senator Van Hollen.
Thank you, Mr. Chairman, and to the ranking member, and congratulations, Mr. Powell, on your nomination. Both the immediate predecessors at the Fed, Chairman Yellen and Chairman Bernanke, repeatedly testified before congressional committees about their concern about and the impact of the rising debt, national debt, on the economy. Here's what Chairman Bernanke told the Joint Economic Committee in June of 2012. He said, large deficits and debt over a long period of time raise interest rates above levels where they normally would be and crowd out private investment and are bad for growth and productivity. They also may involve borrowing from foreign lenders, which is also a drain on current U.S. income, unquote. Do you agree with Chairman Bernanke's statement?
Yes, I do.
And here's what Chairman Yellen said this year on July 12th before the House Committee on Financial Services, expressing her concerns about rising debt. She said, current spending and taxation decisions will lead to an unsustainable debt situation with rising interest rates and declining investment in the United States that will further harm productivity growth and living standards, unquote. Do you agree with that statement?
I do.
All right. Now, obviously, if we increase the national debt, we're going to make those problems even worse. In other words, the long-term debt impact harming economic growth. Isn't that the case?
Yes, I think the idea would be to get GDP growing faster than the debt over a long, long period of time.
Do you have any reason to doubt the Congressional Budget Office's analysis of the debt increase that would result from the bill that's been proposed here in the Senate by Republican senators?
To tell you the truth, Senator, I haven't looked at that. It's not something that we're responsible for.
No. So you have no reason to doubt those numbers, do you?
I have no reason to know those numbers, let alone doubt them.
Do you have a concern about what the debt impact of actions the Senate and the House take, whether on the tax side or the spending side, with respect to the economy?
So it's a bit of a fine line that we have to walk on this, and I'm hoping I can walk it. And that is, clearly the debt needs to be on a sustainable path. We all know that. I think we all agree on that. On the other hand, it's not for us to be taking part in the discussion that you and your other elected colleagues are having over this. That's not our role. And, there are agencies who have that role. It's really not for us.
Okay. Well, both your immediate predecessors commented repeatedly about their concern over the impact of rising national debts. And you just indicated that you shared their concern and agreed with their earlier statements. So putting aside whether or not you think the CBO analysis of $1.5 trillion addition of the debt is correct or not, if there was another $1.5 trillion addition of the debt, it would make a bad situation worse, would it not?
It would, all else equal.
Yeah. And as Chairman Bernanke said, you know, a number of years ago, he said, and I quote, "So at some point Congress is going to have to make a trade-off between what its spending programs are and what taxes it's willing to," he said at that time, raise. We are now talking about reducing the amount of revenue coming into the federal treasury, but the basic math remains the same, doesn't it?
It does.
Right. So if you want to avoid making the debt even worse, and you're going to add $1.5 trillion to debt, the only way to deal with that is to then cut things like Social Security, Medicare, Medicaid. Isn't that the case?
You know, there are a lot of moving pieces in it. As I mentioned earlier, what the country really needs is to have debt growing faster than GDP. What matters is our debt to GDP ratio. That's what makes us on an unsustainable path. So growth also enters into the equation.
That's right.
But yeah.
And the Congressional Budget Office, they do have their own projections, as you do, as was indicated earlier, of what the projected growth path would be. There are things that we may or may not be able to do to improve that. But there's no analysis out there, no credible analysis, that suggests that when you have a massive tax cut primarily going to major corporations, that the result is actually going to be a growth that actually makes up for the lost revenue in terms of debt. Do you know of any credible analysis that shows that?
Senator, I honestly, I've not been following the analysis.
Do you know of any credible analysis that indicates that this tax cut would, quote, pay for itself?
I am not an expert on what analysis is out there about this tax bill, this proposal, this set of proposals.
All right. Well, I would urge you to follow the tradition of your predecessors, who were very careful not to wade into the specifics of the fiscal decisions made by Congress, but did express this concern about rising debts, and I thank you for your testimony. Thank you, Mr. Chairman.
Thank you, Senator Perdue.
Thank you, Mr. Chair, and thank you, Governor Powell, for being willing to take on this responsibility. I'm encouraged that we're having a conversation about our debt, and I appreciate the conversation you and I had privately about it, and I like your considerations on that. I'd like to remind the committee, you know, in the last 16 years, we've added $14 trillion to a $6 trillion debt at the end of 2000, 4 under President Bush, and 10 in the last administration. And in that last administration, we had the lowest economic growth in United States history. In the next 10 years, if we do nothing from today, this federal government will add $11 trillion in current dollars to the current debt. So we'll end up, right now, the current projection is if this government doesn't change the way it does business, we'll add $11 trillion to the debt. In 2000, the size of the federal government, Governor, was $2.4 trillion in constant dollars. Last year, it was $4 trillion. There's our problem. We collected more tax last year than any time in our history. And the year before that, we collected more tax than any other time in our history. Globally, we have $200 trillion of debt. Of that, 60 is sovereign debt. Of that, 20 trillion is U.S. debt. And yet, a number of countries have interest rates in their sovereign debt that actually are put out at negative interest rates. And I don't think the world's ever seen a situation where we had the 4 major central banks with somewhere around $18 trillion on their balance sheets, and a situation where we have $200 trillion of debt, of which 60 is sovereign, and of that, a significant number is let out at negative interest rates. As you think about restructuring your balance sheet, what concerns you relative to the size of government debt, sovereign debt around the world, and of that, the United States being 1/3 of that sovereign debt in terms of how you are going to manage one of the 4 major central banks going forward?
Thank you, Senator. So I think we have a good plan, and I think the market agrees to shrink our balance sheet. We've laid out very clearly in a series of public minutes over 3 meetings over the last year. I think we were quite careful to socialize the plan, and the market has accepted it, and it will lead to a much smaller balance sheet, and it'll do so over what in these matters is a fairly quick period of time, 3, 4, 5 years, kind of a range of things. So
Are there any, I'm sorry to interrupt, are there any assumptions in that calculation or in that thought process of the freeing up of capital on the private side in terms of the money that's withheld from being active in the economy today? Some estimates as high as $6 or $7 trillion are not at work in the U.S. economy right now because of fiscal policy, not monetary policy. Does that weigh into that decision?
actually, it doesn't. What happens, Senator, is that when we allow a security to roll off, Treasury will reissue a comparably sized security or in bulk the same amount. The U.S. government debt will remain the same. It'll just be issued to the public rather than being on our balance sheet. That's what will happen. So it doesn't add to capital. You point to the other central banks, and there are big balance sheets, but they're some way behind us. And you know, ideally over time, all of our balance sheets can shrink.
But all four of the balance sheets are around $4.5 to $5 trillion right now. It's the highest they've ever been. And so, you know, I applaud your background and I applaud your ability to deal with that. I'd like to see in cybersecurity, in a minute I've got left, to talk about blockchain technology. It's a little bit off the wall, but I think I'm beginning to be very concerned that we have another bubble that is some 4 or 5 times the size of the dot-com bubble in the late 90s. And that has to do with the cryptocurrencies like Bitcoin. Bitcoin's market value now is bigger than all but 29 of the S&P 500 corporations in America. You know, assuming that this continues, and talking about that bubble, and the size of and the growth of the use of these cryptocurrencies, if that continues to grow, to what extent will that affect your ability to affect results from your typical monetary policy options that you typically have as a central bank?
You know, in the long run, cryptocurrencies of that nature could matter. They don't really matter today. They're just not big enough. There isn't anywhere near close to enough volume for it to matter for us.
That was the problem with the dot-com bubble, too, on a different level, was there were so few entities and there was so much money interested in chasing it, and that's what's happening right now in the Bitcoin area. But the growth of that area was much, much faster than anybody thought at that time, too, in the late 90s.
Yes, there's no question the valuations have really gone up quite a lot in the last year or so. I don't have a view on the appropriate level of the valuation, of course, but again, from our standpoint, cryptocurrencies are something we monitor very carefully. We actually look at blockchain as something that may have significant applications in the wholesale payments part of the economy, something we pay close attention to.
So you're watching what Alibaba is doing in Asia today relative to blockchain technology?
We are watching all of those technologies. It's something we have to do, I think, and something that's actually kind of enjoyable and interesting to do.
Well, thank you for being willing to do this. Thank you. Thank you,
Thanks,
Mr. Chairman.
Senator Cortez Masto.
Thank you, Mr. Chair. Welcome, Governor Powell. It's good to see you again. Thank you for taking the time with me. Welcome to your family. It's great to see you here as well. So I'm going to start with something, a little topic, a little different. President Mester of the Cleveland Federal Reserve gave a speech earlier this month where she noted that more immigration is needed to drive the U.S. economy at a time when the population is aging and productivity is stalling. Governor Powell, do you agree with President Mester that we need more, not less, immigration to help drive our country's long-term economic growth?
Senator, as I mentioned earlier, the size of the labor force is an important determinant of our potential growth over time. Labor force growth is really slow these days. It's about 0.5%. You know, you go back 30 years, it was 2.5%. So it's a big reason why our economy has slowed down, and immigration has been a real contributor to that. Having said that, immigration is another one of those issues that's really not in our lane, and really those decisions are for you and your elected colleagues.
No, I appreciate that, but we've been talking about growing the economy, and part of your purview is labor, and I appreciate your comments that immigration is an important part of that labor force that grows our economy, so thank you. As chair of the Feds Committee overseeing the Federal Reserve Bank's operations, including the presidential search processes, we have seen some improvement in the diversity of the regional bank presidents, the boards of directors, the bank's workforces, and better interactions with advocacy groups in the bank's communities. If confirmed, what will you do to increase the diversity of the leadership, workforce, and opinions in the Federal Reserve System?
Thank you. As I mentioned, I am a big supporter of the Federal Reserve System and also of diversity. I think we make better decisions when we have diverse voices around the table. And that's something we're very committed to at the Federal Reserve, both at the Board of Governors and in the reserve banks. So, and that's something I've been deeply involved in during all my time there. And I would say that, so I've had a chance to, this is something people have been working on for decades now, and you begin to see what works. And so my view of what works is a lot of private companies have been very successful in advancing diversity. And what seems to work is to have a holistic plan that you stick with over a long period of time, and it's about recruiting, it's about going out of your way to bring people in. Once they're in, it's about giving them paths for success, and it's about having an overall culture and company that is very focused on diversity and that sticks with that focus for a long period of time. That works. It's not something you can do overnight. You mentioned the Reserve Bank president searches. That's something that I have been responsible for. I assure you, we always have a diverse pool of candidates.
And I agree, and I appreciate that's not just check the box. It is a cultural change that is constant. So thank you for your comments there. Congressional Republicans are set to pass, as we've discussed today, a tax cut bill geared towards large corporations. At the same time, this committee is about to consider legislation to roll back rules for some of the nation's largest banks. What can you do at the Fed to ensure that this tax windfall and this deregulation actually benefits workers and doesn't just translate into more executive bonuses and stock buybacks?
Well, our tools are what they are. So we have monetary policy, which can shove the economy in the direction of stable prices and maximum employment, and we have regulatory policy, which can ensure safety and soundness of institutions. When institutions become more profitable, just taking your suggestion, some of that is going to go to shareholders, some is going to go to customers, some is going to employees. So, but we don't really have tools that affect the distribution of profits.
Right, and so, but you do have a component of consumer protection.
We do.
And you do have a concern about the workforce and growing that workforce and make sure there's a strong workforce, correct?
Yes.
So part of the concern that I'm hearing, and I really haven't heard a lot of that discussion, is what you're going to do to address specifically those consumer protection issues, and particularly also protecting the workers and that workforce.
Okay, consumer protection we haven't actually talked much about. So we've been assigned an important role in consumer protection. We take it very seriously. I'm committed as chair, as I have been as a governor, that with responsibility for our budgets, that consumer protection will have the resources it needs to do its job. Whatever Congress assigns us, we will try to do well and aggressively. And that's my undertaking to you.
I appreciate that. And I know my time is running out, and I will submit the rest of my questions for the record. But I like many of my colleagues, do have concerns. I come from Nevada. Dodd-Frank was there for a reason, because we had a horrific crisis, as you well know. We talked about this. And the deregulation of Dodd-Frank and many of these regulations that were put in place to protect individual consumers are so important. And I'm concerned about rolling back any regulations that is going to open that door and lessen any type of consumer protection, any type of work that we have done, particularly in Nevada, across this country to protect individuals. So look forward to having further conversations with you with respect to the idea of tailoring your regulations as well. Thank you.
Thank you, Senator.
Thank you. Senator Shelby.
Governor Powell, congratulations. I look forward to voting for you and helping any way I can get you confirmed. I think it will not be long, hopefully, that you'll be over at the Fed as the chairman, and you'll have a full complement over there, which you'll need, and you'll put your stamp on the Fed. And I hope it will be in a good way based on your experience in the past. We've talked about a lot of things here, but I'm going to get back to basic inflation scares, if any, price stability, which is so important, is one of your mandates. A lot of economists are puzzled by the outlook of inflation statistics at times. You mentioned or alluded to that there's not real, these are my words, not yours, not real pressure on wages, which is always a big factor. I don't see a lot of pressure from energy costs and so forth. We are in a different economy than some of us grew up in with the globalization of things. Where do you alluded to the fact that you do have a open market meeting soon, and you could bump up the interest rate some. I hope you will not spook the bond markets, you know, in doing this gradually, because certainty is important in the economy and predictability. So where do you see the specter of inflation? I don't see the psychology of inflation out there, which is a dangerous thing. I don't see the wage stuff and other things I already mentioned. What do you see there that maybe we don't, and that you can tell us about?
Okay. Thank you, Senator. So inflation has been below our 2% objective, I think, every single month, or maybe every single month but one since I joined the Board of Governors in May 2012. And for most of that time, it's been in the range of 1.5%. It is actually really important that we achieve our 2% target, because our credibility is important on that front. And lately, inflation was moving up, and it got pretty close to 2% beginning of this year. And then this year came, and we have actually stronger growth. We have a healthy labor market, but to my surprise, to all of our surprise, I believe inflation readings started to come in weak. And that was a surprise. And the question is why? There are multiple possible explanations. One is that these are just idiosyncratic factors, like the ones that you hear about are there was a big drop in pricing for mobile telephone services because of a price war, and also a change in the way they calculate that. In addition, pharmaceutical prices, basically, underlying inflation moves according to a slowly changing, evolving trend, but then there are these factors that move around a lot, and we happen to have had a number of factors that push it down. And there are different views, and we've been very public about this debate that we've been having in the FOMC and in our public remarks, as you mentioned. And, the one question is it transitory, or are there more fundamental things at work here? I think we're all watching carefully to see, and, we'll have to be guided by the data as they come in.
We really don't know yet, do we?
No, we don't.
Is it transitory, or is it a larger trend? But you'll be watching it day by day, right?
We will, and that's what will dictate the path of our policy. We can afford to go more slowly if we determine that inflation is going to perform lower than we thought, and we can move more quickly.
Let's talk about the balance sheet just a minute. I think you're on the right trajectory, but I think you used the term that you might draw the balance sheet down to $3.5 trillion, something like that, whatever. Is that the new norm? Because that was not the norm. That's still a pretty high threshold. And if you did draw it down to, say, $3.5 trillion, does that hamper you down the road in case you had some drastic things to do?
Senator, I would say that we don't really know with any certainty what the new normal will be. My own guess would be, and this depends on a number of things that I'll mention, but would be more in the range of $2.5 to $3 trillion, which is $1.5 to $2 trillion smaller than our current balance sheet. Ultimately, what will dictate the size of the balance sheet is going to be the public's demand for our liabilities, particularly cash, which has been growing surprisingly fastly in a world where everyone seems to use electronic cash. Nonetheless, people like paper cash a lot, and also demand for reserves, which are going to be higher than they were because of requirements for banks to hold high-quality liquid assets. The highest quality liquid asset is our reserve. So somewhere in that range of 2.5 to 3 might be the answer. It might be a little higher, a little lower.
In the area, the other mandate you're all involved in is regulatory, the area. Is it important when you come through the Fed or FDIC or anybody comes through with a regulation, proposes a regulation, that they have some type of serious cost-benefit analysis before they implement a regulatory change?
It is, Senator, and we always try to implement the laws that you pass, we try to turn them into regulations as appropriate, and we try to do it in the most efficient, least costly way that we can that's consistent with Congress's intent. And, you know, over the last 3 or 4 years, we've really raised our game, I think, significantly on this, and we're doing more of that. We've been putting out, for example, white papers in connection with big rules like the GSIB surcharge or the others I could mention, and they explicitly solicit comment on cost-benefit analysis. We've also started a unit that is of economists and policymakers that's going to focus very particularly on cost-benefit analysis. So I think we're always trying to be better at that. We regard it as a very fundamental part of what we do.
You also mentioned the word capital, which is very important to any financial institution, and I think it's key to bank survival and financial survival. But liquidity is important too, isn't it? You can have all the capital in the world if you can't have liquidity. Don't they kind of go together to have a strong institution?
They do, and in fact, liquidity, as you suggested, liquidity runs is really what kills banks. Mm-hmm. You know, when they die. But having higher capital makes it much less likely that there'll be a run on the bank in the first place. So that's the sense in which I agree with you that they do work together. They're both important.
Thank you. Thank you, Mr.
Thanks, Senator.
Senator Tester.
Yeah, thank you, Mr. Chairman, and thank you for being here, Governor Powell. I want to start my comments by echoing the ranking member's comments on Janet Yellen. I think she's done an incredible job in a very difficult situation when she came on board, and she needs to be recognized for that. Governor Powell, I appreciate you being here today. I guess the debt is about $20 trillion. Could you give me any idea on what an additional $2 trillion would impact, how that would impact the economy, another $2 trillion in debt?
Holding all else equal?
Yeah.
Well, you'd have higher interest costs, obviously. It would, you know, if you hold all else equal, then you have higher interest costs, and either taxes will have to go up to pay for that, or you'll have even more debt, and that will crowd out private capital and
Is there any numbers that you have on potential impact to the economy the higher the debt goes? Is it 0.5%, 1/4%, a full percent per trillion? You know?
I don't have that handy, no.
Okay. I mean, the reason it's important is because about 1/3 of our current debt is due to the last tax cut that was done during the Bush administration, and so I think we need to get the right information. I don't know that there's anybody on this side of the aisle that doesn't want to see a more simplified tax code and want to see a tax code that doesn't drive the economy in a positive direction. But I think the reason the ranking member asked you the questions he asked you, the reason I asked the questions, because there's just not a lot of information out there on what the impacts are going to be, and after it's done, it's too late. And I just wanted to make that point. It's not in your portfolio, but it will impact your portfolio very significantly moving forward. There's a bipartisan bill out that we're probably going to address, I think, later this week or next week, called the Economic Growth, Regulatory Relief, and Consumer Protection Act. Have you had a chance to take a look at that bill? It's a bipartisan bill. I think there's 20 co-sponsors, 10 Ds, 10 Rs. Have you had a chance to take a look at it at all?
Yes, I have, Senator.
Okay, so, and I wasn't here earlier, so if this has been asked before, I apologize. But as you looked at this bill, are we doing anything that's going to put our financial since I'm a co-sponsor, I say we, putting our financial system at risk with the regulatory relief that's in that bill?
I really don't see anything. You know, we're looking at it carefully. We're going to offer technical comments, but I don't see anything, no.
Okay. Part of that bill is eliminating the Volcker Rule compliance for community banks with less than $10 billion as long as they have less than 5% trading assets and liabilities. Any concerns there?
None.
Okay. There's a GRIPA process that the Fed completed earlier this year. A portion of that review talks about synchronization and streamlining, I think something that everybody can get behind. I think it is key that the regulators need to work to share information so that they're not being duplicative. It is something that I hear a lot from community banks. Do you have any plans as chairman, because I think you will be confirmed, but do you have any plans as chairman to update and modernize the examination process between regulators?
Between regulators?
Yeah, so that there isn't that duplication.
Assuming that if I can assume for a second that I will be confirmed,
yes,
then that is something that I am committed to trying to do better on. We are blessed with a a lot of regulatory agencies in our system, and some of that is good, but it does lead to overlap and duplication. I'll be committed to improving on that.
As you look at your position, and you're no rookie to this, you've been around the block a time or two, would you say that the number one job that you have to do as chairman of the Fed is to make sure that consumers aren't harmed without harming the safety and soundness of our financial system?
I can't disagree with that.
Okay, good. Just real quick, and I got about 50 seconds here. Senator Heller and I introduced the International Insurance Capital Standards Account. It would require the Federal Reserve to create an advisory committee on international insurance standards. It would require more transparency surrounding the process when the standards are being set. As chairman of the Fed, how would you work with prudential regulators to ensure that the Fed fully understands the nature of these entities and their current regulatory oversight?
So for insurance companies, I think we have acquired a significant amount of insurance talent at the Fed and in the other agencies and on the FSOC, and we'd be committed to understanding the industry as best we can, and by the way, for our regulation of the insurance industry to be as transparent ex ante as we can make it.
And so you would agree that the insurance capital standards would be different than financial capital standards? Financial institutions.
The risks of those institutions are quite different.
Yeah.
We're aware of that.
Thank you. Thank you very much. Thank you, Mr. Chairman.
Thank you. That concludes a first round. There have been several senators who've asked for a second round, and so we will do that. I will forego, although I reserve the right to jump back in, but I'm going to go immediately to our ranking member, Senator Brown.
Thank you, Mr. Chairman. Again, thank you for being here, Governor. I want to follow up somewhat on Senator Cortez Masto's questions, comments. Since 10, and also I think Senator Schatz and Van Hollen mentioned some of this. Since 2008, bank profits are up, executive compensations rebounded, but wages for working people are stagnant. The wealth gap between whites and, on the one hand, and African Americans and Latinos on the other hasn't narrowed. Many people in my state have yet to feel the impact of the economic recovery. You know all those things. I hope they're central to your chairmanship. Past Fed chairs Bernanke and Yellen cited inequality not just as a humanitarian and personal problem, but also a pressing economic problem. There's nearly a consensus among economists that income inequality and wage inequality is a drag on growth. Do you agree with that? And if so, what do you do to address income inequality?
I do agree with that, Senator. And I would say, to me, the most compelling factor, I think a number of factors are at work here, but if you look at the flattening out of U.S. educational attainment in the 70s and 80s, and you look at the rise in inequality, the stagnation of middle-class incomes, median incomes, those two stories fit together so well that I think that the way for U.S. workers to compete in the global economy is through having skills, the best education in the world, and in a sense, that is a big part of the story behind inequality.
Okay, but the question was, what do you do? You're not president. What do you do? You're not a member of Congress that should do more to invest in retraining and education and in early childhood education. What do you do to address income inequality?
We don't have a lot of tools to address income inequality. We don't have tools to address distributional effects really at all. But I would say that our commitment to to our dual mandate, in particular to the maximum employment mandate, is to make sure that anyone who wants a job either has one or can find one relatively easily. That should help.
Does that give you pause when some say you can raise interest rates because we're at full employment, knowing full employment maybe for people that look like me that get to go to college is full employment, but people people of color, people that have left the workforce, have given up on a job, that it's not full employment for them. Doesn't that construct give you pause for thinking about increasing interest rates?
Yes, of course, and we are very focused on pockets of people and different pockets of people for whom the recovery is not real yet, and people who groups have higher unemployment rates than others and higher poverty rates than others and that sort of thing. I think we do deal at the aggregate level, and it's important to say that we're raising interest rates now because the economy is strong, and if we wait too long, I'm not saying we're waiting too long now, but if we were to wait too long, the economy could overheat, we'd have to raise rates, and the economy would have a recession. That wouldn't help those people. So the best way to sustain the recovery, I believe, is to continue on this path of gradual interest rate increases.
As I asked you privately about coming to Cleveland, as your predecessor did, and seeing Ohio, high-tech, good, strong, productive, efficient Ohio manufacturing, I would echo what Pope Francis said in exhorting his parish priests soon after he assumed the papacy to, he said, go out and smell like the flock. And I would ask you to think about doing some of the things that she did, not that you pattern your chairmanship after any one of your predecessors, but to really talk to people and see people who still aren't in this economy that's been pretty good for people like us, but not so good for others. One other question. Financial crisis, as we know, wasn't the result of a single bad decision. Dozens of small choices, including by regulators, to change the rules and weaken supervision for the big banks. We know that. Earlier this month, FDIC Chairman Grunberg said he's feeling, quote, a certain sense of deja vu, unquote, with bankers and policymakers becoming complacent to risks in the financial system. Between this legislation, this committee is set to consider that the chairman and you talked about, and all the deregulation in the works by the administration and regulators. Look whom the president has put on some of these and boards and regulators. We're on course to weaken the rules for large regional banks. We're on course to make stress tests and living wills easier for global banks. We're on course to insert yet more exemptions into the Volcker Rule. Are you certain that all these changes aren't paving the way for the next financial crisis?
Certainty is a kind of a high standard, but I'm confident that we're not. That's really not the intent, and I don't see how the kind of things we're talking about doing would push us in that direction particularly.
Potentially fewer stress tests? Don't?
Well, that's not something we've decided. I think stress testing is a really important post-crisis innovation, maybe the single most successful, and the banks will say that to you privately.
I know you've said it, and I know the banks have said it.
Yeah.
So should we be even considering pulling away from stress tests in even the regional banks?
Well, I think I would go back to tailoring. We really want the most stringent things to be happening at the systemically important banks, the most stringent stress tests in particular, and we want to taper as we go down into less significant, less systemically important institutions.
Weren't some institutions like Countrywide smaller, and I think Washmu, if I remember right, smaller than some of these regional banks that will have a relaxed stress test or a less frequent, less than annual stress test?
Well, again, that's not something we've decided.
But it's something you weighed in on a moment ago, and again, on a bill that Congress is looking at.
I think you're referring to the idea of having regular stress tests as opposed to annual.
Periodic, I think, is the word, which is
right?
a very different word from annual.
Yeah.
Does that concern you, or does that give you discretion to decide?
I haven't had a chance to as we discussed, that's not something that we've looked at yet. The bill.
Well, but you're coming to this committee, all due respect, Governor, you're coming to this committee saying you support this legislation, and now you're saying, well, you haven't had time to really look at it. So I guess that means you're not publicly yet supporting this legislation that you might, after digesting it as the chairman, decide to support.
Well, it's not the legislation. It's what we do with the legislation after we're passed. I think it'll be in our discretion to decide, I take it, if I understand the legislation correctly, proposed legislation, to decide how frequent stress tests would be. They'd be periodic. And I don't know what we're going to decide about that. I mean, we haven't looked at the question, is what I'm saying. I think, we're going to exempt banks below, I guess it's $100 billion from stress testing. So that makes some sense to me. Those banks are not systemically important. Between 1 and 250, we'll do something else, and I honestly don't know what that will be. My strong preference will be that we will continue to have meaningful stress testing for them, because I think it's a successful tool.
Thank you.
Senator Warren.
Thank you, Mr. Chairman. So I want to follow up on Senator Brown's questions about full employment. As you know, Congress gave the Federal Reserve a dual mandate to pursue maximum employment and to keep prices stable. The official unemployment rate is now 4.1%. Many economists are predicting the rate will dip below 4% in the near future. An unemployment rate this low in the past would have been considered full employment, which would be good news for the workers that should be accompanied by higher wages. But wages have barely budged. So let me start by asking Mr. Powell, given that wage growth is so weak, do you believe that the labor market is currently at full employment?
So full employment is not it's not a sort of a precise concept in our thinking, in my thinking. And I think a number of indicators would suggest that we are at or around full employment. But I'll point to a couple that suggest that maybe there's more room for growth in the labor market. And those would be in particular wages, which you cited. There's no indication in wages that the labor market is overheating or even hot. And that there's
How about stone cold?
well, we have
To people who are trying to live on those wages, I think that's how they feel.
So you have growth of about 2.5%, which is roughly in keeping with increases in productivity and inflation. But nonetheless, it's not as fast as that growth is not as fast as it was at other cyclical peaks or before the crisis. So that's an indicator, I would agree with you, that suggests a lack of tightness in the labor market.
So let me just push on that a little bit, because one possible explanation for the breakdown in the relationship between low unemployment and increasing wages is that the labor market is not actually that tight. As you know, individuals who aren't actively looking for jobs aren't counted as unemployed under the traditional U3 unemployment measure that the Federal Reserve relies on. A better measure of the strength of the labor market might be the prime age employment rate, which is simply the population aged 25 to 54 who actually hold a job. And as of last month, the prime age employment rate was only 78.8%. In other words, almost 1 in 4 prime age workers, that's 24 million Americans, don't have a job. And while the prime age rate has been increasing, the proportion of prime age workforce who actually have jobs is well below the high that was set back in 2000. So, Mr. Powell, there are a lot of reasons why the prime age employment rate is so low, but I want to focus on one that is not typically on the Federal Reserve's radar. According to recent research by Princeton economist Alan Kruger, about 44% of prime age out-of-work men said they had taken pain medication within the preceding 24 hours, and about 2/3 of them are taking prescription pain medications. So, Mr. Powell, if you're confirmed as chair of the Fed, how does this affect what you will do as Fed chairman to achieve full employment?
Well, let me just agree with everything you said about prime age participation. That's the other place I was going. Is a full percentage point lower than it was before the crisis, and there's no real obvious reason for that. That also suggests some slack. In terms of participation by prime age males, and particularly Alan Kruger's research, what we can do is we can push harder on maximum employment. I think we're doing that. I think we are looking at an economy that's going to go under 4% unemployment. Ultimately, though, the tools for dealing with the opioid crisis and with the long-term 60-year decline in participation by prime age males, those are tools that Congress really has to wield, not so much the
So
Fed.
just to make sure I'm following this, it's your opinion that in order to ensure that the United States labor market is reaching its full potential, Congress needs to deal with the opioid crisis. Is that fair?
Yes.
So I want to ask you about one other factor holding back prime age workers. More than twice as many prime age women are out of the labor force as prime age men. And according to a recent study by the Hamilton Project, more than half of women who are on the sidelines in the labor market cite that they aren't working because of caregiving responsibilities, either for children or for seniors. Mr. Powell, how can the Fed bring women who aren't working due to caregiving responsibilities back into the labor market?
Again, we don't really have those tools.
Good. And that's really the point I wanted to make here. I appreciate your making the point that the opioid epidemic and the lack of paid family leave are holding back workers, and that Congress has to do something on both fronts. If you're confirmed as chair of the Federal Reserve, I hope you will promise to come before Congress to advocate for policies to make our labor market and our economy stronger for everyone. Thank you, Mr. Powell.
Thank you, Senator.
I'll take that as a yes.
Thank you.
Thank you.
Thank you. Senator Cortez Masto, do you wish to ask
I do. One more.
All right, you will be our final questioner.
Thank you.
Thank you.
Governor Powell, large banks have been fined a combined $160 billion since the crisis, yet recidivism continues and regulators have been very reluctant to impose harsher penalties. Take, for example, Wells Fargo, which has a new scandal that arises, it seems, every week. Do you view the post-crisis response on the part of regulators towards the largest banks as being too harsh?
Well, I guess I would I would regard the fact that we're still seeing things like what you referred to in the paper as very disturbing. I don't think I would characterize our reaction to these kinds of problems as too harsh. I do think it's appropriate that we strike a professional tone in our supervision and regulation of financial institutions, and we always strive to do that. But no, my main reaction to what you referred to is one of concern that institutions are still having problems with bad behavior, bad conduct toward consumers.
So can we then address the issue, and I'm looking at this as well, but the conversation that you just had with Senator Brown regarding stress testing and the changing of the threshold, which would then diminish any type of stress tests for Wells Fargo as well as Bank of America and some of the others. Is that true, the way you read the bill?
No, I don't think it would have any effect on stress testing for Wells Fargo or the other larger institutions. It would only affect institutions between 100 and 250 billion in assets.
It wouldn't impact them domestically, their domestic operations here?
No, it would not. That'd be my understanding.
If it did, would you have concerns?
It would depend on what the effect would be, but I don't see any case for legislation of that nature that would affect the largest and most complex institutions.
Thank you.
And I know I said I would let Senator Cortez Masto be last, but I'm going to take the chairman's prerogative and ask you a couple other very quick questions. In fact, I just wanted to go back and clarify my understanding of an answer that you gave to, I believe, Senator Heller. But one of the senators asked you what your understanding was of the current GDP rate of growth in the United States today.
Well, for the year 2017, about 2.5%. I would say for the last 3 quarters of this year, it's more like 3%.
All right, and then you did mention what your expectation was as to what we could expect in the next year or two, didn't you?
I would say in a range. The truth is that there are big uncertainty bands around these forecasts, but my starting point for next year would be in the range of 2.5%, 2 to 2.5%, something like that, which is better than what it's been for the last few years. But that's just where I would start.
And then, do you have any? I know I'm kind of pushing you out further and further, but for for next year or the following year, would you expect them to stay in the same range or not?
I'd have no confidence on a forecast 2 and 3 years out. I mean, ultimately, as we're nearing full employment and everybody's back to work, at that point, it'll come down to productivity, and it's hard to see growth quite as high. You might see a little bit lower growth.
Lower than
2.5%. You could see growth more like 2%.
So it could be 2 to 2.5.
It could be.
It's hard to say.
Very hard to say. Yeah.
All right. Thank you very much. And I appreciate the fact that you've been here and answered all the questions. We appreciate your willingness also to serve the country, Governor Powell. For senators, all questions for the record need to be submitted by Friday at noon. And Governor Powell, we ask for your responses to those questions by Monday at 10 a.m. So please respond quickly to questions you may receive from the senators. With that, this hearing is adjourned.
Thank you, Mr. Chairman.
Thank you.